Hello, today we're going to be making a video here about CVS Health. They just recently increased their dividend by 10%. So we're going to determine the valuation based upon a few things. We're going to go ahead and look at their free cash flow here. As you can see, the last quarter pretty good. We'll just go down here and we'll use over the last 10 years from 2013 to 2022. As you can see, from 2013 we were at 3 billion. We're up to 13 billion as of last year. This is the quarterly flow right here for September. That was just reported recently. So those are just things, to keep in mind too when you're doing valuations for businesses. You can always come look at their assets. As you can see, it's increasing by 8% as of the last quarter. Their total liabilities also increasing by 10% to here. Long-term debt, 17% increase. Cash on hand, 19% decrease. You can always look at their margins. Profit margin 2.4% as of September 30th. Gross margins, as you can see, it's increasing. So that's always a good sign. You can always look at their operating margin, see right here. If you come over to their revenue, though, it is increasing 10% over the last 12 months. As you can see right there, 10%. But we're going to go ahead and keep it conservative, as you see 2019, about a 5% growth rate. Net income, as you can see, increased 158% year over year. Their shares outstanding is currently at 1.290 billion, which is a 1.9% increase or decrease, which is good for investors. So we're just going to use some of these metrics and come up for evaluation and redetermine where we see CVS at currently for value. So if you come to our intrinsic calculation with 5% growth rate, 10% discount rate, 2% perpetuity, 1,290,000,000 shares, we come to a discounted cash flow price of $110.27. If you come to our dividend discount model, their current dividend yield is 2.66. A growth rate, we're going to be using 7% going forward. That's pretty close to the last 5 years. And they just grew their dividend by 10%. We're going to use a 10% discount rate. This is not accurate right here because if you put in CVS, you can see their current trading price, which is $73.40. Their discounted their dividend discount model price is $94.87 with this calculation, which would be a 25% increase. And here is our discounts. Even at today's current price, a 20% discount is giving us undervalued. Even here, if you look at the 30% discount rate, it's undervalued. So if you come to the Benjamin Graham model, we're just going to use a PE of no growth of 10 for a company like CVS, a 5% growth rate, and we're looking at $72.41. For whatever reason, if they were to continue a 10% growth rate going forward, doesn't really change much. So just keep that in mind. Oh, wait, there we go. It changed it. Yeah, it changes a lot. $144.10. I accidentally typed in 0.10. So, just keep that in mind when you're talking about the. Oh, no, I was right. It didn't really change it. 0.10 watch, which is 10%. Which is a 10% growth rate. 10%. Yeah, see, it didn't really change it. 72, 77. So if we come to our final valuation, we got $110, 94.87, 72.41. It comes to an intrinsic value of $92.43. Give ourselves a 20% discount rate, is still undervalued. A 10% discount rate, 83.18. It's still undervalued at the current metrics. So currently, I would say CVS might be looking a little bit attractive, but please dive into some of the things that we brought up here today, like their assets. Go to their cash on hand, look at their cash on hand declining and their long-term debt increasing almost by the same amount. Their total liabilities increasing more than their total assets. So you might want to look into those things before you invest in CVS. Thank you. Have a good day.